Hello guys, welcome back to Ride Academia. Today we're going to be looking at adjustments, mostly adjustment to the financial statements. Okay. Um, Today's video, like I said, we're going to be checking the various factors that will cause a change. Adjustment has to do with changes. Okay. So there are various factors or transactions that can cause a change or result in a change to the figures that we have in our trial balance. Okay. Already we know that in the accounting circle we record transactions first in subsidiary books, then we move on to the ledger. From the ledger we prepare the trial balance. So all things being equal, the values in the trial balance are supposed to reflect in the financial statement, that is our comprehensive income statement and our statement of financial position, statement of cash flow, statement of changes in equity. Okay, now all things being equal, that is, if there is no change, if there is no maybe no omission, like we did errors that could affect trial balance, right? That will not affect trial balance. There are errors that affect trial balance, meaning that sometimes your trial balance can agree, debit and credit side will agree, meanwhile there are certain errors. In the case where we recorded all that we need to record in our ledger down to the trial balance, the figures in the trial balance should be used to prepare the financial statements. All right. Now, why do we have adjustments? We have adjustment because there are times where certain transactions was not recorded or they were not perfectly recorded. Okay, then that will bring to the issue or the need for adjustment. Okay, we'll have to make those changes because our financial statement should reflect a true and fair position. Okay, we should have true income, true net profit, and then of course true asset and liabilities. We should not be hiding some liabilities. So that's the prudence concept. Okay, so we should not hide certain things. Everything should be reflected even as it ought to. So in the case where we have certain transactions, okay, that were not recorded or that were not perfectly recorded, let me use that word, because maybe some aspects were recorded and the other were not recorded, then of course we will have to adjust the figures in our trial balance. All right, now it is expected that before you begin to learn adjustments, that you're supposed to have basic idea on how to prepare financial statements from the trial balance. That is, in the case where there is no adjustment, you're supposed to have known how to prepare your financial statements from a trial balance given with no adjustment. All right, and again, secondly, I want you to understand that adjustments, you don't learn adjustment all at once. Okay, you cannot learn all the adjustment at once. It is better to learn it gradually. Okay, so you can pick a particular class and then you learn, and then you pick another class and learn, so you can do that step by step, and then you are good with, you'll be good at least to certain major, then you can take everything cumulative and then try adjustment. Okay, now today's video, like we've seen, I'm going to be introducing you to adjustment. Now the first adjustment I'm going to be doing in this particular video is where we have accrued income or accrued expenses. Okay, I said accrued income or accrued expenses. That means I'm going to explain accrued income and accrued expenses, and then we'll take a particular trial balance. The only adjustment we'll be doing apart from closing stock is that we're going to be adding accrued income. Okay, or accrued, or we can even do both. Okay, so we can add accrued income or accrued expenses as the only adjustment, and then we'll see how we prepare statement of financial position, and then statement of comprehensive income, and then the statement of course of financial position. All right, so like I said, today we're going to be looking at our first adjustment. Now when we talk about accrued income, okay, when we talk about accrued income, what do we mean? Accrued, anything that has to do with accrued means that something that is due but not yet paid. Okay, it is due but not yet paid, it is due but not yet received. Okay, so when we talk about accrued income, that means this income was due this particular year, but as at when we are preparing the financial statement, that income has not been received. Okay, that income has not been received, although it is due to you, and that income was due this particular year. Now accrued expenses is the opposite. There's an expenditure you have enjoyed but you are yet to pay for it. So those are expenses that are due but yet unpaid. Okay, they are yet unpaid as at when the financial statement is being prepared. Okay, now what it means is this. Now, like I said, our business is supposed to show prudence. We're supposed to exercise prudence, meaning that we're supposed to reflect true income, true expenses, true asset, liabilities, and equity of a business. Okay. Now, in the case where we have an income that was due to us this year, and then it was not paid, if we do not record that income, it means that our income will be showing, it will be understated. That means it will be showing a balance that is lesser than what it's supposed to be. Okay, and then if we have an expenses that is due but we have not yet paid, meaning that our expenses figure will be lesser than it's supposed to be. So that's the reason why we treat accrued income or accrued expenses by adding it to the figures we have in the trial balance. Okay, so like I said, the income, let's take an example. Maybe the income, total income received was 1,000 naira. Okay, in the business year, it's an assumption. 1,000 naira was received for the business year. Now, somebody is also owing you. Okay, they have not yet paid, but they are owing you 500. Now that income is due for this year. That means the person, you have rendered the service to the person. Okay, you have rendered the service this year to the person, but the person has not yet paid that income. Let's say commission received. Maybe you've helped the person to sell, okay, but the person has not given you the commission. Or maybe the business invested in another business, okay. You're supposed to receive what we call what dividend when you invest in another business. So you've invested throughout the year from January to December. You're supposed to receive your bill, your dividend. But as at 31st December, dividend is yet to be paid to you. So you have not received dividend. Now, these are income that are due to you, but they have not been paid. Okay. Now, if you do not reflect them, it means that what will be showing is only what have been paid, which means that our income will be understated. So what we have to do is that even though you've not received it, okay, what you do is that you add back this amount, 500 naira that is due but not yet paid. You will add it back to the amount that was paid. And this amount that was paid will reflect in your trial balance, okay? So you add back this 500, this is an accrued income, and then you make a note on it that they are owing you this money. Whatever people owe you is your asset, it's a current asset, okay? That means when you get to the financial statement, you will reflect this amount that is owing to you as an asset, a current asset, okay. Under the current asset, you reflect this amount because we don't hope that this money should be owed to us more than 1 year. That's why we are saying it's a current asset, okay. It should be paid in less than a year, okay. It's not supposed to stay more than one financial year. All right, now the opposite, like I said, I want to do the accrued income and accrued expenses. So the opposite is the accrued expenses. Now accrued expenses is a liability to you as a business person, okay, or as a business. Now you have wages. Let's use salary for example, okay. You have salaries, you've paid salaries 500 naira in your business account, and then you are still owing some workers. At the end of the year, they have worked for you, they have served you, okay. You are supposed to pay them, but as at when the year ended, you are yet to pay, okay. You are yet to pay them. So in that case, what you are going to be having is that you are having expenditure for the year that is understated, okay. So you're supposed to, you are owing these people, let's say 200. You've not paid all the salaries, so you are still owing a balance of 200. It means it's a liability for you. You are owing somebody. That's a claim of an outsider on your business. This 200 is your liability, okay. Now, so you have to recognize when you come to the comprehensive income, you will add back this amount so that you can get the total expense or total salary for the year, okay. But now when we get to the financial statement, you take this amount separately to reflect as your liability. You will not reflect the 700 total as your liability. Why? Because you are not owing 700, you are only owing 200. So it is that amount that you are owing that you have not yet paid that will reflect as your liability. But in the comprehensive income, you will show the total 700 as the total expenses for the year. Okay. Now the same thing for the accrued income. Even though you have not yet received it, the total income for the year is both this one that you paid and the one that has not yet been paid, that the one that you have not yet received, you are yet to receive. So you show it as total income for the year in your comprehensive income statement. Now, when you go to your financial position, you will now reflect this 500 that as at when this account was being prepared, it has not yet been paid. That's 500. So it is what? A current asset, okay. It's your current asset, meaning that the money is supposed to be received. You've rendered all the necessary services, but the money has not yet been what? Been paid. So we're going to quickly take an example, and then we'll prepare the comprehensive statement, and then we'll prepare statement of financial position very, very quickly.